Hey everyone, welcome to another video by Stock Trades. My name is Matt, and today we are going to be looking at real estate investment trusts. These are companies that typically pay out a higher yield, very sought after by income investors, and we're going to take a look at a few today. But before we do that, just a reminder, we are running a giveaway for a 1-year subscription to Stock Trades Premium. To win, you got to make sure you subscribe to our channel, like the video, and comment below. Very important comment. If you don't interact with the post, then you can't win. So good luck to you. And with that, we're going to start talking about REITs right after this. So why are we talking about real estate investment trusts today? Well, we thought that it was a good opportunity given that the threat of rising rates is going to drive some attractiveness in this area. First, let's start with the reason why. If you'll remember, the Feds had previously said that inflation was transitory. Well, it's certainly not. We knew it wasn't. Any consumer who's on the ground buying goods and paying for services knew that inflation was not transitory. It is on a steady rise, and as a result, rising interest rates are only a matter of time. In such an environment, REITs tend to do pretty well. Why is that? Well, because typically when inflation rises, property values rises. REITs are also in a position to raise rents in line with inflation. So while borrowing costs do go up, which does impact REITs, that's somewhat offset by the fact that they can raise rents and because their property values go up. And REITs are often valued based on their net asset value. So as property values go up, so too does their net asset value. So this is why REITs tend to actually do pretty well in a rising interest rate environment, despite higher borrowing costs. So with that in mind, let's take a look at our approach to investing in the industry. First and foremost, let's break down the industries. There are 5 main sub-industries in the REIT sector. Those include industrial, residential, office, retail, and healthcare. There's also a 6th, which is a diversified REIT, and those are companies that are invested across multiple industries. So they're not really focused on one industry in particular, but they're heavily invested and their assets are spread out across 2 or more of these sub-industries. When it comes to REITs, we know that over the past couple of years, office and retail have been under significant pressure. Why? Lockdowns. Lockdowns have led to less in-person shopping, which has impacted the retail industry, and work from home has significantly impacted office REITs. Now that was then. The good news is that now that we're coming on the other side of lockdowns, office and retail REITs are actually well positioned to make a rebound. To what extent is yet to be seen. One of the things we are not sure of is whether or not work at home is going to become a permanent staple. We know that many organizations are now making it an option for their employees. What we don't know is how many people are actually going to take them up on that, or how many are actually just looking forward to get back into a social environment. So it's going to be something that we're going to have to watch, and this is why we're kind of staying away from office REITs right now, and same thing with retail REITs. You know, online shopping is only going to continue to grow. The demand for in-person store shopping is only going to decrease. Even the grocery industry is being disrupted by, online shopping and grocery deliveries. So right now we're in a wait and see mode for office and retail REITs. That being said, they are 2 of the cheapest in the industry, but we're just not ready to jump in right now. That being said, there is one in particular I want to talk about, and that's RioCan Real Estate Investment Trust. We want to spend a little bit of time talking about RioCan because it is one of the most widely held real estate investment trusts in the country. It's also considered a bellwether for the Canadian economy because of its large exposure to the Canadian retail environment. Unfortunately, it's also been one of the worst performing because the company slashed the distribution by 1/3. It went from $1.44 per share to 96 cents per share, and that sent ripples across the industry. This used to be a Canadian dividend aristocrat, one of the most reliable income stocks in the country that consistently raised a dividend. All of a sudden, given the very difficult environment caused by the pandemic, it had to cut the dividend. That wasn't well received by investors, and since then it has been underperforming. That being said, things are starting to look up a little bit for RioCan, which is why we want to talk about it today. The company recently reported quarterly results in which it, delivered pretty strong cash flows, and it also raised a dividend again. This time it raised a dividend by 6.25% to $1.02 per share. This is reflective on an annual basis and it's still well below the pre-cut levels. However, it's a step in the right direction. The company also announced that the distribution will account for between 55 to 65% of funds from operations. And FFO is a key metric in the industry. So the company's targeting 55 to 65%, and it believes that it can raise the distribution by 5 to 7% annually and still maintain that level of payout ratio. So that's a good thing. Once again, we're still not back to pre-pandemic levels, but it's a step in the right direction. The company also made some reference to some of the strategic changes that it's going to be making to its portfolio moving forward. And the company announced that it is going to focus on 3 areas in particular: pharmacy, groceries, and liquor, which right now account for about 20% of tenants. So the company wants to increase that number because they believe that those are the most resilient industries, especially in light of the pandemic. And they also believe these 3 industries are well positioned moving forward. We know that groceries aren't going anywhere, we know that pharmacies aren't going anywhere, and we know that liquor stores aren't going anywhere. The difference perhaps is how those 3 industries are going to deal with difference of distribution. For example, online ordering, online delivery, those types of things. But there's still going to be a need for the space for those 3 businesses to operate, and that will be RioCan's focus moving forward. So that's a good thing. The company is also trying to increase its exposure to residential properties. So that's another good thing. Residential properties are among the most stable. Everybody needs a place to live. We know that in an inflationary environment as well, residential rates tend to do very well. And that is one of the main reasons why RioCan is attempting to grow through the residential industry. So it won't be long before RioCan becomes an actual diversified REIT, when residential accounts for a higher percentage of its current asset base. But for now, it's still very much dependent on its retail portfolio. So there's good things happening at RioCan. It's very cheap, and right now it still suffers from poor investor sentiment, circling back to the distribution cut back in early 2021. So now might be a good time to start looking at RioCan as an opportunity. Remember, this is still one of the largest REITs in the country. So it's not going anywhere. It has to adapt. Now you have to have trust in management to execute on that strategy moving forward. So we know that office and retail REITs are not our favorite. So what is? We've been consistent in this messaging at Stock Trades Premium. Our favorite industry since the start of the pandemic has been the industrial sub-industry. And in our opinion, there's only 2 industrials really worth considering here, and that's Dream Industrial and Granite. Both of these REITs have been among the top performing stocks in the industry, and we think that they'll continue being the top performing stocks in the industry moving forward. So which is our favorite? Well, I'm not going to spoil things for you. If you're interested, sign up to Stock Trades Premium. We talk a lot about these 2 stocks and which is our preference and why. Suffice to say that both are actually really good stocks, but we do have a clear preference. But I'm not going to spoil everything on the video. You can always sign up to Stock Trades Premium, 30-day free trial, see what we have to say. If you don't like it, you can cancel at any time. I did, however, want to point out that industrial is our favorite industry. We still think it has the most potential for growth moving forward, despite a little bit of pullback that we've seen recently. Remember, both of these stocks have been on some pretty significant runs, so the fact that they're pulling back a little bit right now is actually a healthy thing. We still think, though, that the industry is poised for significant growth. Now, to close out this video, I did want to talk about one thing, and that is distribution growth. Right now, there are 10 real estate investment trusts that are Canadian dividend aristocrats, 2 of which trade on the venture and 8 which trade on the TSX index. I have a personal preference of investing in those that are increasing the distribution. One of the main reasons of this is because in an inflationary environment, as interest rates rise, bond yields rise, and that makes distribution and dividend stocks less attractive. Case in point, let's just say for argument's sake, you have a stock that's yielding 5% and you have a bond that yields 5%. Well, income seekers and those who are looking for a defensive position are likely going to choose the bond over the stock because the bond is a safer investment. So what happens in an inflationary environment is that if the companies are not raising the distribution at a rate that either matches or exceeds inflation, they become less attractive over the long run. Now, this also assumes that inflationary is going to be here for a few years, which it may very well be. So we want to focus on companies and REITs that are raising the distribution. There's not many. As mentioned, there's only 10 right now and 8 that are on the senior exchange. Who has the longest distribution growth streak in the country among all real estate investment trusts? That would be Granite. They have an 11-year streak. It's actually not that long if you think about it. There's actually only 4 that have achieved double-digit growth streaks: Allied Properties, Canadian Apartment, InterRent, and the aforementioned Granite. So it is something to consider. It's not a make or break, especially for some of these REITs that are paying 6 to 9%, if you will. Most of that is sustainable so long as their payout ratios against FFO is below 100%. Many of them are. There are some red flags out there, but not too many. Those who were at risk have likely already cut the dividend because of the pandemic. Many had. So today there's actually only 4 TSX listed REITs who have FFO payout ratios in excess of 100%. 3 of the 4 are small caps, so not really those that we would be looking at to begin with. The 4th is a little bit surprising. That's Summit Industrial REIT, and it's a mid caps. It has a market cap of approximately 3.5 billion, so something to keep an eye on. It's also why we prefer Granite and Dream in this area. They are just 2 companies that are much better positioned than Summit from a financial perspective, from a dividend perspective. They just stick out compared to everyone else. So overall, the industry is actually in good shape in terms of distributions. That's one thing that investors should pay attention to when investing in REITs. Is the distribution growing, and are they in a position to raise distributions in the future? I think it's a very important factor, especially in an environment of rising interest rates. We want to see that distribution keep up with inflation. So that does it for our video today. We spent a little bit of time talking about, why REITs are important right now. Rising interest rates, they tend to do well in this type of environment, especially those in the residential sub-industry. RioCan was widely considered one of the best REITs in the country until that dividend cut, and it has been one of the worst performers. From a valuation perspective, it's looking pretty good now. It's still one of the largest, so it's one that we may want to consider, and probably the only one we consider across the entire office and retail sub-industries. Talked about our favorite sub-industry, which is industrials. Once again, if you want to know which is our favorite between Granite and Dream, sign up to Stock Trades Premium, or comment below, and perhaps you'll win a 1-year subscription to Stock Trades Premium. And finally, important to look for sustainability of that dividend and potential future dividend growth. We want to see that distribution keep pace with inflation. So with that, I hope you liked the video. Comment below. Let us know what is your favorite REIT or perhaps your favorite sub-industry. Which of the 5 do you prefer? Do you prefer retail, office, industrial, residential, or healthcare? Let us know what your favorite is. And as always, like the video and subscribe to our channel for more great Canadian content. Until next time.